Right, so most traders actually think that they understand the ES futures until a 20-point move essentially wipes out their entire account. And here's the crazy part, that mistake isn't in their analysis, it's how they're using the ES. So ES isn't just another way to trade the S&P 500. It's a leverage contract that can essentially multiply your gains and losses faster than any other ETF could. So before you click buy on your next ES trade, let's break down exactly what it is, how it really moves, and why so many traders underestimate it. Right, okay, so let's start off quite simple. So the ES is just the ticker symbol for the E-mini S&P 500 futures contract. So it's designed to track the S&P 500 index, and it trades on the CME. And essentially with the ES futures, every 1 point move is worth $50. So unlike the SPY, which is an ETF you can buy and hold, the ES is a derivatives contract. So you're not buying shares. You're essentially agreeing to a standardized contract whose value moves with the index. And these contracts are cash settled. So there's no delivery of shares. They have quarterly expiration dates. Most traders sort of close their positions or roll them forward way before the expiry occurs. So the ES isn't a stock, it's not an ETF, it's a futures contract. It's built for traders who want direct leverage exposure to the S&P 500. Okay, so let's zoom out a bit. Why does the ES matter? So the S&P 500 futures, they were actually first launched in 1982. Back then, the contract sizes were huge. They actually moved $500 per point, which meant even a small move was worth tens of thousands. And that was fine for big institutions, but it was impossible for small traders to get in. And then in 1997, the CME essentially introduced the E-mini S&P 500 futures, the ES, and essentially cut the contract size down to $50 per point, just a tenth of the original. And that made it much more accessible to firms and, of course, retail traders. And since then, ES has just sort of exploded in popularity. Today, it's the most liquid equity index future in the world, with daily volume topping over 1 million contracts. And that liquidity is why traders sort of love it. It's efficient and it's transparent for retail traders. Right, so now let's sort of dig into the numbers. Let's look at the value of one ES contract. So if the S&P is trading at 6,600, you essentially multiply that price by $50, which is the dollar per point movement, and you essentially get 330,000 of notional exposure. Now, the ES sort of moves in something called ticks, and one tick is a move of 0.25 index points. So one tick is worth $12.50. So essentially 4 ticks equals 1 full point, which is worth the $50. So that means even if ES moves 10 points for a single contract, that's a $500 swing. And a 100-point move, which can happen on Fed days or CPI days, that's $5,000. So if we talk about margin, to hold one ES contract overnight, most brokers require $12,000 of margin. Now, some brokers will actually let you trade ES on something called reduced intraday margin, and that's sometimes as low as $500 to $1,000 per contract. So again, this is what you need to take from this section. The ES moves in something called ticks. One tick is $12.50. 4 ticks is 1 point. 1 point is $50. So essentially 10 points is a $500 swing. Now, another thing to consider is the trading hours. Now, one of the biggest advantages of the ES is its trading hours, its flexibility. So the stock market runs from 9:30 a.m. to 4 p.m. Eastern, and SPY trades within these hours. The ES actually trades 23 hours a day, Sunday evening right through to Friday afternoon, with a 1 hour daily break. So this means the ES sort of reacts to global events instantly. If CPI comes out at 8:30, ES is already moving before the market opens. If Powell speaks at 6 p.m., ES trades in real time. If Asia or Europe drop news overnight, the ES will reflect it. So for global macro traders, that flexibility is really important. But for undisciplined traders, it's a nightmare and very dangerous. We have the ES on the left-hand side and we have the SPY on the right-hand side. So you can see the difference in the pricing between the ES and the SPY. And that's because the SPY is actually an ETF and it's priced at about a tenth of the S&P 500 index. So if the S&P 500 is about 6,700, the SPY will be about 670. And the ES futures are essentially directly priced off the S&P 500 index. So essentially that difference comes from the SPY's built-in 1 to 10 scaling versus ES using the sort of full index level. Now another difference is the price action. Even though the price action is the same, on the SPY chart there's gaps in the chart. And that's due to SPY trading in market hours and ES being able to trade nearly 24 hours a day, which is very important for traders who sort of need that flexibility in the markets. Right, now let's look at the costs. The costs are very important to understand when trading these sort of products. So ES is actually one of the cheapest instruments to trade. So the spread is usually just one tick, which is 0.25 points or $12.50. So if you add in exchange fees and broker commission, you're still looking at very tiny costs compared to other trading products. And liquidity, over a million contracts trade daily, and the order book is very, very deep. That's why ES fills are very, very fast and clean. And if you compare that to the CFDs, like the US 500, where spreads and overnight swaps can essentially decrease your P&L overnight, the ES is very transparent and exchange traded. So the ES is liquid, it's efficient, and it's cheap, but you still need enough capital to handle those sort of swings in the price. So another advantage of the ES, especially for US traders, is its taxes. So futures actually get something called a 60-40 tax treatment, which means that 60% of the gains are taxed at the lower long-term rate and 40% at the short-term rate. And that doesn't matter how long you held the trade for. So for scalpers and day traders, that's a pretty big edge compared to trading SPY or other equities, which are essentially taxed at 100% as short-term gains if you're sort of in and out quickly. Also execution. Execution is very clean on the ES. ES trades on the CME centralized order book. So everyone sees the same market. That means tighter spreads, deeper liquidity, and fairer fills compared to the fragmented equity market, where orders sort of usually have to go through multiple exchanges. Right, so now let's look at the sort of leverage in practice. This is the number one reason why retail traders blow up their accounts, because they don't understand the leverage aspect of the ES. So one ES contract controls 330,000 of notional value. The S&P was at 6,600. And to hold that contract overnight, the CME requires roughly $12,000 in margin. That's not the price of the contract. It's the sort of minimum cash you need in your account as a sort of security to cover potential losses. So with that 12,000 on deposit, you're controlling 330,000 of exposure and essentially works out to 27 to 1 leverage. Now, during the day, most brokers reduce the required margin. And at that level, you're essentially running 300 to 600 times the leverage. And a move of just 10 points in the ES will essentially be a $500 swing. And essentially, that is your entire margin and your account wiped out. Right, so now let's look at the beginner pitfalls. So here are the biggest mistakes I see beginner traders making with the ES. So number one, trading without stop loss. ES can move 20, 30, 40, 50 points in minutes on news. And that can be $1,000 to $2,500 swings against you per contract. So without a stop, one trade can essentially blow your entire account. So you always sort of need to define your risk before entering your trade. Always have a plan. Number two, over leveraging small accounts. A $2,000 account trading ES on reduced intraday margin essentially has no buffer. So a normal 20-point move is essentially $1,000, and that is essentially half the account gone. People think they're maximizing opportunity here, but essentially you're just putting your account in constant danger. Number three, treating the ES like the SPY. So essentially here you're forgetting that each point is worth $50. Traders are used to seeing the big movements on SPY, but on ES it's not the same due to the leverage. So if you treat ES like the SPY, you're essentially going to underestimate the risk and oversize the trade. Number four, ignoring overnight volatility, also very important. Remember, ES trades nearly 24 hours a day. So what sort of looks calm in the New York market can essentially explode when the Asian and European markets open. Retail traders sort of love to hold overnight, thinking it'll be quiet and that the volatility will be very low. But then they wake up to a margin call, and that's because news broke out across the other side of the world overnight. So essentially, avoid these four mistakes and you'll be ahead of the majority of retail traders that essentially blow up their account every single week on the ES. So who should trade the ES? If you've got an account over $10,000, you understand risk management, you want real-time access to global news and micro moves, and you can essentially handle the volatility without sort of panicking. And you should avoid ES if you're undercapitalized, you trade without a back-tested system or plan, and you don't understand how leverage works.